Hello again, fellow BeachBum traders. Thank you for joining us for part one of our weekly trading game plan for the trading week of October 24th through the 28th, where we're saying welcome to Tara. Tara stands for there are reasonable alternatives. There are reasonable, real alternatives to stocks. And we've been talking about this for a couple of weeks. Last week, it was why we had to say goodbye to Tina, which is in the past couple of years, there were no alternatives to stocks. So someone coined that term, Tina. There is no alternative to stocks. So again, now there are real, reasonable alternatives, and we'll talk about some of what those alternatives are, what those real, reasonable alternatives are, and strategies both for trading and also just the realization of how that affects our trading. So again, thank you for joining us for our weekly trading game plan part one for the trading week of October 24th through 28th. So we'll get started. Thank you to everyone that's joining us in the live stream today. Walter Lyons, Ollie in the Bay, the Blind Trader. It's nice to see you all here. Thank you for joining us again. So here's our Google document with our notes for our weekly trading game plan for this week. You should be able to find a link to this Google document with these notes in the description box below, as well as to the Google Drive public folder that contains our notes for our weekly trading game plans. Again, they're publicly accessible. You should be able to find a link in the description box below so you can reference all the tools, all the references that we're using in our weekly trading game plan. So we'll start out, we'll look at the homepage in FinBiz, see how we ended up the week. We see Friday was nicely positive. It was a little, the whole week was kind of wild. Last year I had several weekly trading game plan videos called relative to Mr. Market's wild ride, and it's been another wild ride this week, but I didn't want to reuse that same theme again. But so we saw, Friday was up. We'll talk about some of the reasons why we think it was up, even though, we had some earnings that were very disappointing. Snap, we can see Meta and Verizon. Verizon had disappointing earnings too. But we see again, all the indices happened to end up on Friday. So we had a lot of advancers, more advancers than decliners, although very few hit new highs. Again, the majority of stocks are still below their 50-week moving average, 76%, and almost 80% are still below their 200 moving average. So although it was a bullish day, we're still quite a bit below our moving averages. So if we look at some of the recent news, NASDAQ freezes Chinese small cap IPOs. Investors brace for the busiest week of earnings. Yeah, we'll talk about there's a big week of earnings coming up. A lot of the mega caps, the big FANG names all have earnings this week. So we'll talk about what's coming up and how to play that. We see crude was choppy. We had some news, and we'll cover that when we get to some of the economic news for the week. But it was pretty choppy. Natural gas plummeted down below 5, so it's really been on a downtrend lately. You can see it's now 5 seems to be acting as a resistance. Again, gold, silver were choppy as well. A lot of that had to do with the dollar's strength. Again, very choppy. Bounced up 112, 113, and then back down. And so we see the euro is made a run back up towards parity. British pound was choppy. You all heard about the turmoil in the British politics. So a lot of news affecting the markets and the currencies, commodities, etc. So we'll take a look at the indices in detail. Look at the SPY first, the S&P 500. So we see, and I want to zoom out in a second, and we see it bounced off this bottom trend line, bounced back up, got up above its shorter term moving average. So it's testing that moving average, riding that moving average. So here we see what looks like a potential capitulation candle. So it's a little bit of a fat doji, but we do have that wick down and then a bounce up where it bounced off the body of the previous candle. So this may or may not be a capitulation type of thing. Although something that was ironic during the week is although the indices were declining, the SPY was declining, the VIX really never perked up. So we didn't really get a VIX spike on that S&P wick down. It never really got much above 30. And so, that's one of the signs of a bottom is a spike in the VIX, and we didn't really get that. So whether or not we're at a bottom is hard to tell. Same thing with the NASDAQ, the Qs. So again, we see that one candle down and then a bounce back up, although it's significantly below its moving averages still. We've got a 1 weekly candle up. At the Dow. Now it's had a couple weeks of uptrend. It's approaching its 50-week moving average, so that's going to act as some resistance. So we'll see if it breaks through or gets rejected from that moving average. Look at the VIX. Again, we see the VIX has just been declining. It went up to 33 or so several days ago, and it's been the peak was what October 13th looks like about the peak in the VIX. Only went to about 33, and it's been retracing ever since. So again, even though when the market was going down, the VIX was not spiking. So whether or not we've gotten a true capitulation or not, we're not getting all the signals that would indicate a true capitulation. I missed the Russell. Let's look at the Russell a sec. So it's got a multiple bottom down here. It looks similar to the S&P. It got up above its shorter term moving average. It's hugging that moving average. And it looks, more like the Dow here, where it's on a weekly basis, it's testing that moving average. We'll have to see. It looks like it got rejected once. We'll see if it can break out of that longer term moving average. So Walter Lyons says, I think the rally on Friday began an announcement of the federal budget deficit. Yeah, also there was some talk by one of the Fed presidents that, and again, this was an interpretation. People took what the Fed president said as a little bit more dovish, that maybe they weren't going to be as aggressive hawkish as everyone had expected, and I think that attributes a lot to the rally too. My personal opinion, none of our videos are financial advice. We're not financial advisors. This is for education and hopefully some entertainment purposes only. But again, in my opinion, I think that's a misinterpretation. I think the Fed's still going to be very hawkish, very aggressive. We'll see the employment, the job market still very resilient. And I think, we'll still get a 75, and then we'll see. But again, they interpreted some of the talk as maybe being more dovish, and I think that attributes a lot to the rally. Although, what you're saying is certainly valid. And the dollar did fall off, and so commodities ran up a little bit. So we'll see that in the futures. Good morning, Judy Tubman. Thank you for joining us. Glad to see you. Okay, so we looked at the VIX, we looked at the Russell. Another one I want to look at, I thought this was very interesting, and we'll talk about our strategy for playing the VTI. VTI, as you can see, is the Vanguard Total Stock Market Index, and we've been watching that. We have a strategy where we want to use the VTI as a long-term investment, long-term swing. And one of the things I like about looking at the VTI is it's not just the S&P, it's not just one of the indices. It's a combination of all the U.S. indices. Pretty much, it covers I think about 400 stocks in the VTI index. And so it's a little less sensitive to a particular index. Industrials is more the Dow, technology is more the NASDAQ, S&P is a little bit more diversified. But this guy is much more diversified. So if we look at it here again, we kind of see a potential capitulation down there. It looks like maybe we've got a bottom, And if I zoom back out a little bit, it looks more like the S&P bounced off the lower trend line, broke above its moving average, is hugging that moving average. And if we zoom out to the monthly, again, it bounced off that longer term moving average. So I thought that was interesting. Again, the VTIs can be a little less volatile than any one of the indices. And again, tomorrow we'll talk about our strategy for investing or swinging the BTI. So, but I thought that was interesting. Good morning, flip of the Shippa. It looks like we've got some unwanted spam in our chat, so I guess we're getting more popular. It's the first time I think we've had that. So now let's also look at the groups, the sectors. So again, Friday we see almost everything was green. We saw a big comeback in the basic materials. They tried to run technology. We see, industrials, financial energy's been, we talked about the sector rotation in and out of energy. So pretty much everything was green. The underperformers on Friday was real estate communication, and part of that's Verizon. So for the week, again, energy, technology, basic materials, healthcare, defensive real estate, and utilities at the bottom. Good morning, DS Lives. Thank you for joining us. Good to see you as well. So longer term, and we see this has been a recurring theme, is energy, basic materials have been strong, real estate, utilities weak, technology has been, rotational, and they've been trying to run technology. So it's been up and down. And again, energy is the long-term. Energy, basic materials are the long-term theme. So, but again, we're seeing, rotations in and out of these. They're picking off the bottom sector. We see real estate slowly moving up. I wouldn't be surprised eventually if we see a rotation into real estate, although we know the real estate market, at least the home building real estate market's in a recession. So. So if we look at the industries, see again, basic materials and energy, oil, steel, silver, gold. Finally, we've been talking about aluminum. If you remember a couple weeks ago, aluminum was at the bottom. And so again, we see these sector rotations where they're picking them off the bottom and then, running them up. So silver, steel, etc., coal. Again, coal was depressed. We'll see the same thing in solar's now at the bottom, gold, uranium, etc. So energy, basic materials on Friday. And we see at the bottom, again, we've got some REITs, healthcare REITs at the bottom, several of the other REITs. That's real estate at the bottom. Again, oil, energy, basic materials for the week. Transport, so coal was at the bottom and it bumped up to the top. So again, we've talked about how to play these sector rotations for quite some period of time. And for the month, you see solar's down here and real estate. So, I wouldn't be again surprised to see them try to see money flow into solar at any point and see that try to run. So check for questions quick. Okay, so we talked about all that. Okay, so let's talk about the economic data from last week. Let me grab a drink a second. I'll go ahead and load the calendar. Let that load a second. Okay, so let me review my notes, and just a reminder that as this economic data comes out during the week, I try to grab it off investing.com, try to grab a screenshot, try to grab that data, post it in our Discord. So we've got a Surf the Markets channel in our Discord. And as you'll see, I try to post that data off of investing.com here, as well as other observations in terms of, market news, market behavior, futures, etc. So our Discord's free to join. You can find an invite in the description box below. Also on our homepage, on our YouTube About page. Again, there's links to the invite to our Discord. And again, free to join. We encourage and welcome everybody to join us in the Discord, the bigger community we have, helping each other out, helping everyone succeed in their trading is our objective. So getting back to the economic data, not a whole lot Monday, Tuesday. Wednesday, we got mortgages. See mortgages keep going up. So again, the housing industry is in recession and declining due to increasing mortgages. So building permits was up a little bit more than expected, but starts is down. Again, housing starts are down. This was interesting, is that we had mixed data on oil. And again, we saw the price was volatile. So we saw inventories were down, which normally you would expect that to cause the price to go up. And so it did go up a little bit. And then, as you'll see, we had Biden announcing releases from the Strategic Petroleum Reserve. So more supply coming out of the SPR. So that's more supply. So again, oil was pretty volatile. It did run up. I think it tested 90 and then bounced down. I think it's sitting, right now it's sitting at 84. So it did come back down. So gas production is up a little bit. Gasoline inventories was as expected. So here Biden announced they would buy oil to refill the SPR at less than or equal to $70. So he was announcing that, trying to encourage oil companies to produce more. And it was very interesting because I was watching the oil price at the time that Biden was talking. And so this is increasing supply. So you would expect the price to go down, and the price was going up as he was announcing that. So no, I guess nobody believes that the oil companies are going to produce more. So, and this put the floor on the price, right? So they said, around $70 in oil, they're going to put a floor on the price and refill the SPR at that price. So again, initially oil went up. I think we'll see in the futures. I think it tested 95 maybe, and then now it's come back down and it's down to 84 again. So and probably headed down unless something else happens. So Thursday we got jobless claims. You can see initial or continuing was a little above expected, but initial was below expected. But these numbers in combination and the average was pretty much as it previously was. So all this, I interpret this to say, again, as we've been saying, is the job market is resilient. We're not seeing massive unemployment. We're not seeing a big bump in the unemployment, and these would allow the Fed to be more aggressive, more hawkish in raising interest rates due to less fear that they're going to dramatically impact employment right away. So again, we've been talking about this. So again, I interpret this to say, okay, we can expect continuing interest rate hikes. A very aggressive Fed. So I don't expect anything to change. So Walter Lyons says, so we can presume oil will not slip below 70. Well, again, they're putting a floor on the price and saying, hey, they're going to buy at no less than 70. Again, it's the price itself is pretty unpredictable. I don't know if you all remember a couple years ago when the price of oil futures actually went negative, which doesn't make any sense. So the prices can be irrational, but that is what they said, is they would buy the floor. Their floor price would be 70. So that does help buoy up the price, right? So we saw existing home sales pretty much, as expected, but down. So again, the housing market's in a recession, and then we got this natural gas storage number as well, and the storage number was higher than expected. Um, by a significant amount. And again, natural gas prices are volatile, sometimes quite irrational. And again, this indicates a higher supply, but the price went up initially, and then it turned around the next day, and now it's back down. Now it's down to below 5, and it hasn't been below 5 in months. So um, this does indicate more supply, so I expected in the longer run that the price would come back down as it has been declining. But initially, again, the price ran up. So and Friday was options expiration. So again, I expected more volatility. We really didn't get the volatility. I mean, we got some oscillations in the indices, but again, the VIX is just sitting. Let me see where the VIX is sitting right now. It's probably 29-ish something, 29.69. So again, we're not seeing, massive swings in the indices, and the VIX isn't popping up. So another indication of oil supply is the rig count, the Baker Hughes rig count that comes out every Friday, and you see it increased just slightly. So we've got a little bit of an increase in supply, but not really significant. So again, this would indicate, except for what OPEC's doing, they're cutting production, but says U.S. production is increased just a little bit. So let's look at the economic calendar for next week. See what we've got coming up. So we've got PMI, production manufacturer index. It's expected to decline a little bit. That would indicate slight decrease in inflation. We'll see again if this misses expectation and inflation's hotter than expected. That could be a negative on the market, right? Housing, we know, is the housing market's in recession. Consumer confidence has been improving slightly. Got mortgage rates expected to keep going up. Wholesale inventories, new home sales, again, oil. These are pretty typical. And then, jobless claims on Thursday. Again, if something comes out vastly different than expected, that can cause, volatility in the market. GDP data. So this is Q3. So that may be significant. It'll tell us, are we in a deeper recession than we thought or not? Or what is the recession, the curve, the trajectory of the recession look like? Initial jobless claims. And then core PCE. So again, this is an important one that the Fed looks at. This is again for September, so it's a revisions on September. So again, if we see any dramatic change, that could be a source of volatility. PCE data, okay. And then Michigan sentiment, consumer sentiment. So, we don't have any major economic data, but we do have significant economic data. So while I'm here, let's look at earnings real quick. This is where one of the places I look at the earnings calendar. So you could just, select the earnings tab on this on the calendar in investing.com. We've got a lot of major earnings coming out. So let's see, Monday we've got Discovery. And again, you can go through this list. I would encourage you to see if any companies that you're looking at buying, you currently own, or ones related to a sector that you own, because obviously they're going to impact. We saw what happened with Snap, right? Snap had bad earnings, their ad revenues down. That's going to negatively impact everybody in the digital advertising arena, which I expected more of the FANG names, Facebook, Google, etc., to have more of a negative reaction to that on Friday. But again, several of the other factors I think overrode that. So, watch out. if Facebook comes out negative, Apple, Google, etc., that can really hit the market pretty hard. So there we've got Alphabet, which is Google on Tuesday. Coke should do okay. We've got some defense, GE, some industrials. Twitter, again, everybody's waiting to hear what's going to happen with the takeover there, etc. So there's Spotify. So again, we've got a lot of earnings this week. This is a big week for earnings, so I would highly recommend you look through the calendar, keep up on the calendar, and see what impact that might have on stocks you hold or looking to buy. Yep, heavy hitters on deck this week. Yep, a lot of the FANG names, so JetBlue, some airlines. So yeah, the list is this is probably the heaviest week for earnings. I could be wrong. There's Microsoft on Wednesday, Meta on Wednesday. So again, a lot of tech hit on Wednesday. Again, the list is very long, so I won't belabor that. You all can look through that in more detail. And I'll show you in Webull where you can see a nearer term list of the earnings as well. So just a reminder, the next FOMC meeting is November 1st and 2nd. So they'll come out with their actual decision on the 2nd, and they'll have a press conference, etc. So in terms of, that is the next major event for volatility in the market. Now, again, my personal opinion, I expect a 75 basis point. I think most people in the market is expecting a 75 basis point interest rate hike. I think they're still factoring in the potential of 100 basis point. I don't think that'll happen. And I don't think a 50 is reasonable. I think it's going to be 75. And I think that's what everyone expects. So, it'll be more, what is the commentary? What do they say about their trajectory going forward? So we'll see. But again, if you want to prep for that, we'll talk about possible ways you can prep for volatility around that Fed decision. So here's the market screen on Webull. Let me make sure I didn't skip something. So I like to use the market screen as well in Webull to do market analysis, etc. This is the online browser version of Webull. This is the market screen. If you're not already using Webull, they're still offering their 12 free stocks. So when you open and fund a new account, again, Webull's our favorite trading platform. I use it for, my market analysis, as you'll see, due diligence. We do most of our trading on Webull. And you can get 2 free stocks worth up to $300 each just for opening account. And then if you deposit any amount, even $1, you can get 4 to 10 more free stocks worth up to $3,000 each. So, if you're not already using Webull, why not open an account, put $1 in, get up to 12 free stocks. You can cash them out and take the cash if you don't want to use the platform. But again, we use it for all kinds of things, and we do the majority of our trading in Webull. So again, on the market screen, we can see we had, last week this was leaning the other way. We had more decliners than advancers. This week it's leaning to the green, but the percentage advance is relatively small. We have a small long tail of decliners, so there were some that really declined significantly, probably related to poor earnings, and a few that did very well, probably again beats in earnings. So again, earnings matter, so it's worth keeping up on that. We see the NYSE had better flow than the NASDAQ, and it looks like they declined during the day, so possibly related to options expiration. Here's where you can see the near-term earnings calendar. If you just select the calendar earnings, you can also see splits and dividends, but it will tell you whether it's what's coming up in the near term. Is it during market? before market open, after market close, so you can keep up on what's coming up in the near term in that calendar at Webull. So let's look at the best performing industries for the week. Let me grab a drink a sec. Okay, so for the week, see uranium. Uranium had been beaten down, and again, we saw a rotation into uranium, oil and gas. Semiconductors made a recovery, even though the sentiment and the news is pretty negative. We'll talk about tomorrow ways that we can play semiconductors and how we're watching semiconductors, oil and gas, metals mining, basic materials, computers is mixed, transport's mixed. Construction was pretty positive, even though we know housing is in decline. Entertainment was positive. Carnival. Communications, this is showing positive. And aerospace and defense. We heard Lockheed Martin did very well, and that kind of propelled the aerospace and defense. Tomorrow we'll look at some, an ETF for the defense industry. We could talk about that again. Walter Lyon says, "Oops, uranium got away from me." Yeah. We'll look at tomorrow several that we're watching in the uranium sector. Again, we're seeing rotations in and out of energy, so all it would take is them pushing the energy sector like XLE, pushing all the energies down for a day, and maybe we'll get some opportunities. So we'll talk tomorrow about some specific uranium stocks that we've been watching and would like to take advantage of. So then we'll look at ETFs. So the markets right now, Dow up, S&P up, Bull 3X. So yeah, right now, the markets were all up on Friday, so they're betting up. VIX, that's interesting. They've got a yen in the VIX one. Russell up. FTSE, China, looks like a couple are showing up. Industry-wise, pretty much it's all green. Healthcare is a little negative. Again, this is for Friday, so pretty much everything was up. Commodities, gold and silver had a nice run on Friday. We'll see that in the futures. Carbon, that's a carbon credit ETF. Crane shares, that's China. Silver. And then bonds. So yen looks like a recovery. Australian dollar looks like, we saw dollar weakness on Friday. So several of the other currencies we'll see made somewhat of a recovery. So even the pound, the euro, etc. So that's weakness on the dollar on Friday. Now we'll look at the futures in FinViz. So again, I've got videos and they're referenced in the notes on how you can use the futures chart, the groups tab in FinViz, etc. to analyze the markets and drill down on individual stocks. If you're like we were talking about uranium, I've shown before how you can drill down on that uranium sector and then filter the companies in that sector to find ones that look attractive at any given point in time. So So we can see this, big green candles on the end of all the indices. We see the Dow looks like it's broken out from its previous high. These guys look like well, the S&P has not broken its previous high yet, but it looks like they might be doing an inverse head and shoulders type of thing. It's still a little hard to tell. Nasdaq is testing its previous high. S&P needs to test its previous high. Same thing with the Russell. And we see the VIX is just declining. So unless we get some other event to cause some volatility, we would expect the VIX to continue down. So we see oil, again, we had a short, run up to 90 or so. Then it bottomed out in the low 80s. See that brief wick up. That was, Thursday, the Biden announcement. So again, right now it's just kind of sitting. It's been bouncing between 80 and 90 for quite a while. See this fall off in natural gas. So it was testing 7, failed, and just, it's really dropped off. So, we've been playing cold, which KOLD, which is the short on natural gas. The other ETF up on natural gas, long on natural gas is oil. Again, short-term trading. You can trade this any given day. It's very volatile. Boil up, cold down. With oil, we tend to use gush long and drip short. There's also UCO, which is long, SCO short, and we'll look at those ETFs again tomorrow. But again, on any given day, these are volatile enough that if you're a day trader, scalper, momentum trader, breakout trader, you can make money trading with those ETFs or individual stocks. But again, the ETFs are, in my humble opinion, are less risky. So. And we see this pop up in gold and silver had a big, pop when the dollar weakened. That they had been being pushed down due to dollar strength. As soon as the dollar weakened a little bit, they pop up. And if the dollar continues to weaken, and if it dramatically weakens, we can expect, pops in these dollar-denominated commodities like gold, silver, even oil, natural gas, platinum. Flip was saying, yeah, platinum did well. Yeah, again, all the dollar-denominated commodities, when the dollar weakens, that releases that downward pressure on them, and they pop. Same thing with copper. So again, they've all been beaten down a lot due to the dollar. We've, a couple weeks ago, we have a whole video on trading, making money trading with dollar strength. So the DXY, the dollar, the strength of the dollar on any given day will dictate, which direction potentially you want to play. So see the commodities are varying quite a bit. Orange juice, they've got a bad crop. It's run up. See, lumber was down and it's been running up, which is a little surprising. Coffee's come way down. There's an ETF, JO. I've been looking at potentially long coffee, but and then we see the treasuries, just downtrending. The yields are going up and the prices are coming down. So we see this, the dollar perked up over 114, then it dropped down to 110, bounced up to in the 113s, and then kind of rolled over. So if we keep this downtrend, again, we expect the dollar-denominated commodities to keep going up. See the euro bottomed and is going back to parity. Here's the yen. Okay, so they're propping up the yen and also with the dollar weakness, and we saw that in some of those ETFs as well. And same thing, all the other currencies popped up due to dollar weakness. So I also wanted to go back to the home and just look at the bond yields. Yeah, I think they maxed out around 4.5 or so, and now you can see there's somewhat of an inversion, but they backed off a little bit, so that released some pressure on the growth stocks, technology stocks, and again, that and the dollar weakness, and just some desire for exuberance allowed the markets to pop on Friday. So now let's talk about our theme for the week. Welcome to Tara. There are real reasonable alternatives to stocks. And we, again, have been talking about this for a while. Last week, the title was, Say Goodbye to Tina. There is no alternative to stocks. And now there are, and the reason being is the high interest rates causes essentially the discounted cash flow is you can now invest in things that provide you with a return based on the interest rates, etc. And again, stocks, particularly growth stocks that are not paying a dividend, become less attractive because the value of your dollar is more valuable in other assets like bonds, interest-bearing accounts, etc. And we'll look at a number of these. So flip of the ship says the bonds are getting very overheated. Yes, and we expect them to continue in the trajectory they're in. We talked several weeks ago about the fact that I expected it's going to have to be between 4 and 5% because the Fed rate is going to be somewhere between, probably 4.50 and 5%. So the bonds are need to approach that level. And at the time, people were saying, no, it wouldn't go above 4. Well, yeah, it's between 4.25 and 5. So I don't expect that to change in the very near future. So let's talk about some of the alternatives to stocks, given that the interest rates are increasing, they're high. So now, bonds are paying a real return. So I included some links to the Treasury Direct. You'll hear about people now are buying bonds. People are buying those 2-year bonds that have a very high yield. They're buying 10-year bonds because they pay over 4%. People are interested in I-bonds. I-bonds are inflation-adjusted bonds, and they're paying a better than 9% return. So I also included the direct link to where you can go to buy I-bonds on the Treasury Direct website. This is the only place you can buy I-bonds is directly through the TreasuryDirect.gov website. You can also find that link. I've got a link to I-bonds on our website, which is BeachBumTrading.com, bum without the U. So if you look in trading resources, reference links, here's a link to I-bonds. That'll get you to the Treasury Direct website. And again, you can also buy U.S. Treasuries there. They'll explain to you the various ways you can buy U.S. Treasuries. So you can buy those 2-year bonds, the 5, the 10, etc., and earn a 4% return on those bonds for that period of time. So again, you hear people actually going out and buying bonds, and because again, it's the treasuries are essentially risk-free, right? So all of this is about risk reward, right? What's the risk and what's the reward on your cash? And people want to minimize the risk and maximize reward. And the question is, where's the balance for you? And that's going to vary by person. Obviously, when do you need the cash? Do you want to lock it up for 2 years, 5 years, etc.? And what kind of return do you need? Because again, the return relative to inflation is important. If we're running 8 or 9% inflation, and you're getting 4% on your money, well, you're losing money, right? So again, and that's what stocks are competing against. If I can get 4% at zero risk, versus putting in a growth stock, well, I might get better than 4%, but my risk is going to be a lot higher. So again, it's balancing those out, and it's all about risk reward. And again, it's going to be based on the individual, but now that these treasuries are paying 4 to 5%, it's not zero like it was. There used to be no alternatives, right? It was you got zero for your money, or you put them in stocks and got something. So now I can get 4% treasuries, I get 9% in I-bonds. Corporate bonds, again, are going to be higher risk, but potentially a higher yield. Municipal bonds for governments, cities, counties, states, etc. Again, they'll potentially have a higher yield. I believe these, at least some of them, are tax-free, so the interest that you earn is tax-free. I don't believe that's true of corporates. There's also this thing called agency bonds, which is something that things like Fannie Mae, Freddie Mac issue. And we've talked about an ETF, a fixed income bond ETF that we've been watching. But again, it's been plummeting because the price of bonds has been plummeting. Just like everybody's the mutual funds, they've got their 401k with that old 60-40 mix. They've been getting pummeled because both stocks and bonds had gone down, and bonds are continuing to go down. So let's talk about some other alternatives to stocks. Where else can you put your money to get a return that might be better than stock? We're hearing a lot of people talk about waiting for the bottom in real estate. Real estate prices are coming down. Some of the high-end demand is drying up, and so people are pooling cash, waiting for a bottom in real estate. Obviously, you don't want to take a mortgage, so they're looking at pooling cash to buy depressed real estate when that market rolls over and bottoms. A lot of this is investment property that then you rent it out, whatever, and generate cash flow. So again, that's where money's going, right? It's coming out of stocks, going into real estate, even CDs. This is just history thing. This is what my parents used to always put their money, and that's all they knew. They didn't know anything about the stock market. They put all their money in CDs because at the time it paid something. Now, in the past couple of years, they didn't pay anything. Well, now they're starting to pay some percentage. I don't know what the interest rates on CDs is right now because I'm not terribly interested in them, but similarly, with high yield savings accounts, now you can put your money in a savings account and earn, a reasonable interest rate at a minimal risk, and that money is liquid. So, uh, okay. So some other areas, some other alternatives to stock is businesses. You can either invest via private equity, which again is private investment in various businesses. Again, that's a lot of your accredited investors, your wealthy individuals. They invest over in venture capital, private equity, so that you're seeing an increased interest in that area. Another thing that you can do, or people are interested in, is buying a business or investing in a business. Again, if they see the potential for a higher return, and again, as another general statement is. You want to get something that's going to be both beat the rate of inflation, and also be resilient to a recession. So if you're looking at any of these investments, real estate, a business, etc., is how resilient to high inflation and a recession is that investment going to be. So again, part of the factors that you balance in terms of looking at an alternative to stock. Judy Tubman asks, "Are bonds safe?" Well, U.S. Treasuries, are backed by the U.S. government. So unless the U.S. government goes under or defaults on their bonds, that's the lowest, probably the lowest investment. As you go up that ladder, obviously you're increasing your risk. So municipal bonds are backed by a city, county. Now we've heard cities and counties go bankrupt. So, there's a little bit higher risk. Corporate bonds, again, companies go bankrupt. So again, a little bit higher risk. However, these are debt instruments, and typically in a bankruptcy, a debtor, a creditor, is paid before any stockholder. So again, these are lower risk than stock in that same company because you are a creditor, and creditors get paid first before stockholders. So I hope that answers your question. So some other alternatives real quick, and then I'll try to wrap up. There's also this, because interest rates are high, some people can't afford to get a loan from a bank. Credit card credit is high. There's this concept of peer-to-peer loans. So if you're the person loaning out the money, you could possibly get a return by loaning to someone. Now, obviously, that's a little bit higher risk. They could default. You could lose your money. But I looked at that several years ago. I haven't looked at it recently, but I expect increased interest in that area. Now, some other alternative investments. All kinds of different things you can invest in. And again, it's a balance of risk reward, cryptocurrencies. Again, it's not a stock, so it floats differently and it's going to be influenced by different factors, although we've seen a lot of correlation due to risk. So risk off, cryptocurrencies tend to get hit. Risk on, they go up. At least that's been the tendency. NFTs, I almost put that under collectibles, but it's kind of related to cryptocurrencies, blockchain, etc. And it's kind of a collectible, although they do have other uses. So also people are talking about investing in fine art. Again, things that are potentially inflation proof, are not, directly correlated with stocks. Land, people invest in farmland. There's an ETF called Land, which invests in farmland. And again, it's real estate, it's land. So, and it will tend to be inflation proof because the value will tend to go up with the value of the dollar. People are talking about fine wines, precious metals. You can buy coins, gold coins, silver coins. You can buy bars. You can also invest in ETFs, and tomorrow we can look at some of the ETFs in these areas in our ETF Google sheet. So also, I actually Mark J. Kohler, and there's a link to his site on our website. Very good tax attorney, investment. They have a self-directed IRA, and they allow you to invest in some of these alternative assets, even from a retirement account, from an IRA. So one of the things I know he's done is bought livestock. And in his IRA, in an LLC attached to his IRA. So again, you can invest in all kinds of things, even in an IRA, but you need what's called a self-directed IRA because your traditional one they're not equipped to allow you to invest in a lot of these alternative investments, even things like cryptocurrency. A lot of retirement accounts don't allow you to invest directly in those kinds of alternative investments, but get increased interest. So I think you're going to hear more about people putting money into these things, which means there's less money going into stocks, so less demand. Yeah, again, it's supply and demand. So if you have more sellers, fewer buyers, prices go down, right? So just real quickly, some of the other reasons why there are reasonable alternatives, high dividend paying stocks, these are going to be more attractive. Again, if they're paying over the treasury bond yield, so if they're over 4.5%, they're attractive. And some of the non-mortgage backed REITs we like is, Realty Income, Stag, LTC. Some of them pay 5% plus. Some of the ETNs based on commodities, GLDI, SOBO is gold and silver, USOI is on oil. These guys pay, in the double digit returns on a monthly basis. So again, these become more attractive. But again, any dividend below 4%, why would you buy them? You can buy a treasury and get 4% at almost zero risk. So again, if people are buying dividend stocks, if it's less than 4 or 5%, they're going to be less attractive, and therefore the demand's going to be lower. So if you have any questions, I'm going to wrap up real quick. I included links that we've talked about and links to videos that we've released or that are currently unlisted in several of these areas. I left most of these in here for your reference. We've talked about, dealing with rising interest rates, dealing with the strong dollar. We've also talked about generating money using covered calls on existing positions while we wait for the markets to turn around. So I've left all the references to those videos in the notes for our game plan, so you can reference those quickly and easily and see those previous strategies. So very quickly, just a question, and I also posted this in the announcements channel in our Discord. There's a money show in Orlando next weekend starting on the 30th. And the question is, I was expecting to be out of town during that time, but that's plans have changed, so I'm going to be around. So if anybody wants to meet up during that money show, if you're already planning on attending, let me know. Maybe Sunday afternoon we could meet somewhere there. So just let me know. You can reply in a comment to this video or in our Discord, and maybe again we can meet up somewhere at the money show, maybe on Sunday afternoon after our live stream. I live about 2 hours away from Orlando, so I can drive over there, and I may well go and tour their event hall Sunday afternoon. So also any other questions you have, please put them in the comments below this video in our Discord. Again, you can find an invite to our Discord in the description box below, in the social media site under links on our homepage, beachbumtrading.com, bum without the U, off the About page on our YouTube channel. So if you have any other questions, please feel free to contact us any of those ways, and we'll do our best to cover them either in tomorrow's part 2 of our weekly trading game plan for next week or subsequently in whatever medium we can. So thank you again all for joining us for part 1 of our weekly trading game plan for the week of October 24th through October 28th. And please come back tomorrow at 10 a.m. Eastern time, and we'll cover part 2. So it'll be our stocks that we're putting on our watch list for potentially trading next week, our various watch lists, our bullpen, etc. And we'll talk about further trading strategies, trading ideas, etc. So please let us know if there's anything you'd like us to discuss. Again, you can contact us via our Discord, Facebook group, social media, etc. So thank you again all for joining us, and have a great rest of your day. Bye.